Welcome to This Week in Real Estate with Jonathan Harmon and Bryan Nale, your local experts on all things real estate in Middle Tennessee. Listen in as they discuss the current state of the market, the latest trends, and have a little fun while doing it. We do want to say the opinions voiced on this podcast are for general information only and not intended to provide specific advice or recommendations for any individuals.
Lord save us all.
No, Brian, I'm not sure what you've been doing, buddy, but you should be sharing, that's for sure. So, hey, everybody, it's Jonathan Harmon, Bryan Nale, This Week in Real Estate. And Brian, I keep looking, I'm looking at the screen right now, and he keeps looking skinnier, and I keep looking fatter. So you can just stop with that, man. I don't need your excess over here.
You know what I did this morning?
No. Let me guess, you ran like 17 miles.
No, I took 2 coats, 2 jackets to A+ Alterations to have them taken in.
Yeah. What is the look that I'm giving you right now?
Hatred?
Mm-hmm. Yeah.
You should start running.
I should definitely not
It's
start
great on
running.
the knees.
Yeah, no, it's ankles for me and knees both. But anyway, I do need to start doing something. So, hi.
Welcome to This Week in Real Estate once again. We're glad you're here watching us. Right now we have 0 live viewers, but I know that a couple of people are going to join live and that a lot of people are going to watch this on replay.
Yep.
So thank you for tuning in.
You know, it's been interesting here over the last probably 3-4 months. I've had several people just randomly come up to me and be like, "Hey, I watch y'all's podcast," and I always say, "Well, thank you very much for that. You're one of 5."
Yeah,
and that's great, man. So anyway, somebody's watching.
It's I go back to my cousin Andrew. Shout out to my boy who said he watches from South Carolina. He's like, I don't care about the real estate market in Middle Tennessee, but you guys are fun to watch. You make me laugh.
Oh, there you go.
And we do have some national kind of trends and stuff that we talk about. Speaking of which,
Andrew, hold
Trent.
on. Cheers to you, Andrew. Every time that I think about headlines, I think of the Beck song, "Kill the Headlines and Put It in Neutral."
Shout out to Andrew. Cheers, brother.
I'm not going to pour it out.
Cheers,
he's
cousin.
not dead. Never mind. Pour it out for never mind.
All right, so yeah, we're squarely in headlines, and Beck, kill the headlines and stick them in neutral. Is that what it is?
Yeah, put it in neutral.
Yeah.
Yep. All right, so we got some headlines. So I'll lead this one off. I read an article, and unfortunately, I tried to find it, and I couldn't find it exactly. But it was a summary, essentially, of what we talked about 2 weeks ago, and this, or I guess last week, and then I read it earlier this week. That's what it was. And it was talking about the very rapid rise in rates that we had over the last, 2 weeks or whatever.
Yeah.
And how it gave us one of the biggest single day, what do we even call that? Deal cancellation rates. What's the word I'm looking for?
I don't know, man.
So loans that were in process, they hadn't locked yet, and rates went up fairly substantially, fairly quickly. They didn't lock, and it killed the deal.
Fallout. We call it fallout.
Whatever we want to call that. So, they were right on the cusp of being able to afford it.
Yeah.
Rate goes up enough very rapidly, and all of a sudden they can't afford. And it was something crazy like, and it doesn't sound like a lot, but really stop and think about this. It was nationwide. It was something like, it was around the 5% mark, 5-6% of all current active deals fell through.
Yeah.
Which, that's a lot.
That is a lot. And you think about what that does to sellers and the pipeline and the moving trucks that are backed up and just the ripple effect of one deal canceling that was going to affect a deal down the line, another deal down the line. And so, yeah, that was a massive move.
Well, and you already have, we're in a weird spot where we have too much inventory and not enough inventory at the same time,
Everything everywhere all at once.
It's so bizarre.
The real estate market of the 2020s.
Yes, exactly. And so, you do something like that, you have 5%, even if it's only 2% of all deals that were already done, those sellers are thinking, we're ready to go.
Yeah.
Right? They're packing, they're doing everything else.
Yeah.
They're no longer show ready.
They're writing offers on another house if they don't already have one.
And then bam, here it comes.
And boom.
And then that house goes back on the market. They have carrying costs. Inevitably, somebody's going to look at that and go, why did that deal fall through?
Yeah.
So it
Something
almost
wrong with that
becomes
house?
stigmatized.
Maybe
Yeah.
there's something wrong with that house. Maybe it wasn't something wrong with the house. Maybe it was that the person who could afford it on Monday couldn't afford it by Thursday.
Just because of a rate.
Yeah.
Something totally out of everybody's control.
So bonus pro tip, we'll get to some pro tips later, but lock your pipeline. Like lock your loan. If you can.
But I don't think anybody saw that rapid of a rise coming, did they?
And rates were on their way down. And so if you're a gambler and you're like, hey, it seems like rates are falling, why lock when maybe we can lock in 2 weeks and get an even better rate? I've seen people play that, and I'm of the mindset of a bird in hand is better than two in the bush when it comes to those rate lock decisions. And
when your company offers the float down,
yes,
talk about that for a second.
Well, you're burying the lead here. So we're going to skip the pro tip section because, no, we can still do that.
Yeah.
So all right. So we do have a free float down. Now it's not like a policy that we have the free float down.
Sure.
We from time to time we will offer a free float down. And so in the interest rate world, in the mortgage world, when you lock your interest rate, it's like a two-way commitment. You are going to, the lender's going to say your rate is locked here at this number. Let's just say it's 6.5%. And if the market moves in a direction that would make rates go up, you're protected. You're going to be at 6.5%. If the market moves in a way that interest rates would move down, you don't necessarily get the benefit of that. You can maybe do a float down where you have a rate renegotiation fee. And so in essence, what a lot of times that will mean is that, let's say you lock at 6.5%, the rate renegotiation would mean that if rates improve a half and you could lock at 6, then you'll get like 6.25. If rates improve a quarter and you could be at 6.25, you might be able to renegotiate your lock to be 6.375. So you're going to usually get about half of the benefit of the gain. So,
but the flip side is if rates go up,
you're protected. You don't have anything to worry about. It's not like the bank can come to you and say, hey, we're going to renegotiate your lock and we're going to put you at 7 now. That's not going to happen. You're locked. And so it can't get worse. And so I like that general rule of thumb more than floating the rate, floating the market and saying, hey, okay, we're under contract. We're closing within 30 days here. Should we lock or should we float? Well, floating was when you don't lock and you run the risk of rates moving up on you.
And especially if you're pushing your approval limit, it's a dangerous policy.
It is.
Or dangerous.
It is a dangerous game
practice.
to play. It's a dangerous game. Yeah. And so when we have the free float down, what we're saying is, hey, if rates improve by an eighth, you'll get the eighth. We have to, and we will let you know if we see rates improve. You can call your loan officer and ask anytime, hey, can you run a comparison to see?
But
if
only
rates are
once
better?
in the process.
That's right. You get this one time during the process, one free rate float down, and we do have that going for the month of March. So if anybody is under contract on a house or maybe shopping for a house and you're interested in how that would work, give me a call. We can talk about your specific situation and if it makes sense to go ahead and lock now, and with knowing that you do have that free float down kind of in your hip pocket.
Yeah. Okay.
We have another market mover, and we're talking about rates. So a lot of times that leads to housing affordability questions. And we definitely are in a real estate market where affordability is a major concern.
Paramount,
for homeowners and for renters, and just housing affordability is a major issue across the country.
Sure.
So we've partnered with Genray to promote or to pioneer this shared equity, shared appreciation thing, and it's called a premise affordability loan. So the premise affordability loan. What Genray is who we do these loans with, and they will pony up a massive amount of money up front to buy your rate down. So you get a significantly lower than market rate interest rate. Now the trade-off is that you are going to have to share your home appreciation, not your equity, but the appreciated value in your home from the day that you buy the house to the day that you either refinance this loan or sell the property. And so it's capped at 2% per year of your appreciation. So if your home appreciates 3% every year that you own it, you'll pay back, and let's say you own it for 6 years, then you'll pay back 12% of the appreciated value in your home.
Interesting.
We've got a cool website with some very intuitive and informative calculators that we can use to kind of show how this works. I am not a gimmicks person. I don't like them.
I would need to play with this to see.
And I encourage that because I'm very skeptical of anything that sounds like a gimmick.
And this definitely does.
And if you've watched this show for a while, you know how much I lampooned and just despised the marry the house, state the rate, and all of the things that people were doing in 2022 and 23 as rates were going up. That I was just like, man, we're using gimmicks to try to get to sell houses, and that's not being advisors. That's not being it's not putting.
It's snake oil.
It's not putting homeowners' interests first. It's trying to help us get a paycheck, and as an industry. Now, not everyone was doing these things, but a lot of people in our industry were, and I don't like those gimmicks. And so when this came out and I heard about it, I was like, all right, let me see what this is really about. If it's something that I can't stand behind, then I'm not going to talk about it.
Sure.
But from what I've seen of this so far, and it's very new, but from what I've seen of it so far, it seems like it's legit.
So how substantial of a rate buy down are we talking?
The average is about 1.5%.
Okay. So if the market rate's at 7%, you end up with a 5.5% rate, which is a pretty massive savings on your monthly payment.
Right. And the other unspoken thing here is that it's not just going to save money on your monthly payment. It's also going to really, if you compare your amortization tables. Oh yeah,
long term.
That lower rate, you're really going to pocket some equity there, and you're not sharing your equity in the home. You're sharing. That's the key differentiator to me, because there's other programs.
But it's the initial equity, right?
No, this is a.
That's what I'm saying. You're not sharing your initial equity.
You're not sharing. Your only part of your equity that you're sharing
is what the market appreciates your house.
Exactly.
So if your house goes from a $400,000 house to a $500,000 house, you're sharing in that $100,000 difference.
At a max of 2% per year that you own the house.
So in that scenario, 6 years later, you sell the house, you make $100K on it, $12,000 goes to the Genray or whatever it is, and so then it still, we cook it down to a break-even analysis, right?
Right.
So if you share that $12,000, did you realize in 6 years $12,000 worth of value, worth of savings?
And when you look at the monthly payment savings and then what you're able to do with that cash flow, maybe this helps you get the home that you really want. Maybe so there's a quality of life play there that you can't really put a money number on. Maybe you're completely comfortable with payment. And you don't need that extra monthly savings to help you with your monthly expenses, and you can just increase your 401k, bump it up, for that difference, or put it into a more short-term savings strategy.
Well, and so go back to your the home affordability. Maybe that's the difference in you buying this house, and then the next stage of life, 3 years later, 4 years later, whatever, you have to buy another house. Instead, you go ahead and buy that second house, and so you can stay a little longer, which anytime that you can do that, the cost associated with generating a new loan, all of that kind of stuff, moving, et cetera, that's a realized savings as well.
I'm pretty excited about this opportunity, and
that's fascinating.
I'm looking forward to talking about it more.
I want to play with the numbers, man. Is there a calculator?
Yeah, there's a calculator. We'll drop the link to that in the comments. I'll send it to Trent later to put it in there. But yeah, this is, to me,
anybody else doing this?
No,
I've never heard of this.
This is only us.
Oh.
Yeah. So it's. I don't know how long it will only be us, but for right now, it is only a premise thing. So I think it could be revolutionary. I mean, there's a trade-off, right? And one of the other things that I love about this, it tells me it's not a gimmick, is that the home buyer has to go through a homeownership education class, not with premise, not with the loan officer, not with someone that we've hired to train this. They go through this program with somebody from Genray, who is going to really make sure they understand exactly what they're getting.
So when you say homeowner education, it's not like the THDA homeowner.
No, this is the education on the mortgage option that you are choosing, so that you will know. We will know that if someone enters into a home ownership with this program, that they have been educated on all of the nuances. Like you think about it, this program prohibits you from ever having a home equity line of credit on the house. And if you wonder why, well, it makes sense. If you have if you start out with 10% loan to value, and then 5 years later you put a HELOC on there, and instead it's chewed up the equity, and there may not be enough equity in the home to pay out the appreciated gain.
Yeah.
So it prohibits you from having a HELOC.
And that's a big deal for some folks.
And so you're going to get the homeowner is going to get all of that little bits of information that a loan officer might forget to cover or might willfully not cover.
What happens if the market tanks?
Generally makes nothing.
There's no recapture where they come after you for.
They have to
no recourse.
There is a recourse for the first 3 years.
Okay.
If you refinance or you sell the house within the first 3 years, they recapture the points the money they put up front for you to buy the rate down. But after 3 years, Genray's betting on the market. They're betting on being able to make
3 years
their money
is short then
for their investment through home value appreciation. So there's no recourse against the homeowner. There's no, oh man, the market didn't go up, so you're going to owe us this much money. Genray takes the loss. They take a bath if the market goes the other way.
So how does that work then on a refi if you get out of that loan, and let's say that you've been really aggressive with your payments and you've paid down, right? Because you could, because you have a lower rate, and then you go to refinance it. Do they recapture? Does that become part of your finance charge to get out of the other loan? Is there do you understand what I'm asking?
I think I do. So I'll try to answer it. You tell me if I answered your question.
Let's pretend that the value of the home is flat.
Yeah.
Right. Or let's pretend that it's not, but it's a $500,000 house. My loan balance is $300K. When I first, I put $200,000 down, whatever, they bought the rate down. I've got a $300,000 loan. I've been super aggressive with it. So I bought my own equity back, right? And I only owe $150K. And I refinance it 6 years later. But the value has stayed the same, or it's gone up, but I've still only refinancing $150.
Your loan balance has nothing to do with the value appreciation of the home.
But is that, if you cut them out at that point, is that when they try to cash out the value?
They will look at the price that you paid for the house, the original purchase price, and the value of that home when you're refinancing it or selling it, and that is going to be their margin. That's the money they have to work with. If you've paid your mortgage balance down to zero, then it doesn't matter.
So if it's gone up $100K in that span of time,
well, I shouldn't say. If you paid it at zero, when the loan's paid off, they're going to recapture the.
That's what I'm getting at.
But they're not going to. They're only.
In order to release the lien, they're going to at that point take the value when you bought it, the value at that present time,
right,
and demand that difference.
Yeah, it goes into your payoff because you have to pay off the second lien.
Yeah,
so the second
it's
lien
a second mortgage
is going to be determined based on what you owe.
It's a second mortgage of indeterminate amount.
Yeah,
basically,
so to speak,
indeterminate dollar amount.
Yeah, so it's
that's fascinating.
It's really interesting, and I can't stress this enough. It doesn't matter what the loan balance is. They're not coming after your equity. They're not.
Right.
I shouldn't say come after. That sounds.
They are, but it's
no. They're coming after a portion of your equity. What you have paid your loan balance down to is definitely part of your equity. That's definitely part of your net worth. But the only thing that Genray is going to recoup is the value appreciation, not what you've paid the mortgage balance down to.
Like you said, they're betting with on the market.
Yeah.
Dude. Okay. So Brian, I got to tell you guys off camera, Brian was like, "Hey, we've got this program." And I said, "Don't stop. Don't tell me about it. I want to learn about it on camera." And I just did, and I am I want to sit down and play with the calculator now. Yeah. Like I'm totally fascinated.
We'll get a copy of the website link to you.
That's awesome.
And anyone else?
This is cool, man.
So we're up to two people watching now.
Oh,
so
there was more than that. For a little bit. So to me, this is especially for someone that is fairly not like they're not worried about risk.
Yeah.
Right. This is a no-brainer for some folks.
So. This to me, where this plays really, really well, because it requires a 10% down payment.
Okay.
So so a lot of first-time home buyers may not be right for this because for a first-time home buyer, some have 10%. It can be a gift. There just needs to be 10% equity in the house to start with, right?
Yep.
So, so that being said, Where I think this really, really helps is those people who bought a starter home or maybe their second home when rates were in the threes and they're looking to move. They've outgrown their current home, but man, they really just don't want to take a rate that's in the sixes or sevens, right?
Or they can't.
And so, but this can help them if they're comfortable with that trade-off, right?
Yeah.
If they're comfortable with the trade-off, they've got a lot of equity in the home that they own. Making a 10% down payment's not going to be an issue for them. If they're comfortable with the trade-off of that sharing the value appreciation, this can make a lot of sense to help them get to their next home.
I like it. It's
I
different.
like it a lot. Yeah.
It's different. Okay. What's next?
This is real.
Yeah.
What a beautiful outdoor living area. I mean, it really is. It's a shame they took a picture through the screen door.
I mean, can you really just not open the door? Good gracious.
Is that a reflection in that thing of like
It looks like news.
like a news? Is there like a TV reflection in the fleur-de-lis ornamental screen door protector?
All right, Trent, you got to turn this one off, dude. This is just aggravating to me. I'm angry at this agent that took this picture, and it was very obviously an agent that took this picture, not any remote version of a professional. Oh my gosh.
Jonathan couldn't even look away for that one. Golly. It looked like a really nice outdoor living area that could have been really highlighted in a selling point to that home.
All you do is open the door.
Yeah, that's a shame.
Even if you just take it on your cell phone, that's a whole other conversation,
which we've had many times.
But just open the stupid door.
Yeah.
Golly, gosh, Moses.
Oh my goodness. All right.
Pro tip: fire that agent.
Let's go to pro tip. Oh, we had one. What was that? Okay.
I can't get over this, man.
We teased the pro tip earlier in the show.
We did.
So, you know, and I just talked about how I didn't like gimmicks, and I felt like one of those kind of gimmicks might have been the lock and shop kind of stuff and the way they were presented. But man, right now,
tell me about lock and shop.
Right
it's
now
different
it could
than
be-
pop and lock. Those are different.
Different things for sure. So this could be a good market to go ahead and lock an interest rate. You want to be very aware of what you're doing when you do this, right? Because it does start a clock. Let's say you are pretty confident that in the next 60 to 90 days you're going to move. You can go ahead and a lot of lenders will allow you to lock an interest rate
Before you have a contract.
before you have a contract on a house. And that starts the clock. So you've got to for you to keep that rate that you've locked, you've got to be able to find a house and get to the closing table during that period of time where you're going to be paying lock extension fees. So my pro tip right now is if you're pre-qualified, you know what rates have done the last 3 weeks. The real good time to do this would have been
3 weeks ago.
3 weeks ago. None of us have crystal balls, but if you're thinking that the
Or
rates
time machines.
are not going to reverse or stay flat, and you think that rates are going to continue to trickle up, and you want to protect yourself against that, you can hedge by going ahead and locking your interest rate before you have a contract on a home, and then getting after it on the home shopping process.
Yeah. Good stuff.
And if you do it while there's a free float down option,
You've got to get out of jail free card.
you got it
One of
in
them.
case rates do improve.
Yeah,
That's right.
I love it. It's good advice. My pro tip of the week goes to sellers right now. And this market, we've talked about this lots. There's everything all at one time going on. Be very careful, sellers, about doing that proverbial gift horse in the mouth thing, right? And so if you get an offer that's at all workable, don't get your feelings hurt. Everybody's looking for a deal right now, and let's try to negotiate. Okay, let's look at the situation and let's evaluate all aspects of what that offer involves. You told me a story sitting out there about how you guys made an offer on a house. This was years ago. It would have been in what'd you say, 2011, 2012, somewhere around there.
Yeah.
Y'all made an offer. It was not a full price offer, obviously. The seller didn't even
counter.
respond.
They
Just
nothing.
did nothing, which essentially kills a deal before it ever starts. Y'all bought the house that you're in, and a year later, the house that you offered on was still on the market, and was at that time listed for less money than what you offered.
Correct.
I saw it happen.
That's a true story.
I saw it happen all the time. So consider all the cost or potential costs associated with turning those offers down. You have carrying costs, you have taxes, you have insurance, you have your time lost. You have, I mean, there's, you have to maintain that house if you don't still live there, if you don't live there.
Even
currently.
if you do still live there, you have to maintain it.
So everything gets put on hold. So just consider that as you're turning something down or you get offended. I tell my sellers all the time, there is nothing offensive about an offer. There isn't. Now, they might be unreasonable, right? And sometimes I get a little snarky, perhaps, with my responses to those offers. But we're going to respond to every offer.
I'd add to that, to this pro tip. When you're reviewing that offer, review it in the light of the information that Jonathan just shared with us in the headlines section. If you thought you were coming into and a lot of us thought we were coming into a very busy spring buying season, and
kibosh has been put on it
since things started open over in the Middle East. That's really, we may not have the spring and summer that we were all excited to have.
True.
So keep that in mind as you're entertaining these offers, that you thought you might find multiple offers. You thought you might get above list price. You thought that the market was was primed to take off. And guess what? You're right. It was primed to take off. And now we've kind of pulled.
There's your bingo card, man.
Yeah. There
bingo card. Let's start a war with Iran.
We didn't, we didn't see that coming.
No. Interesting. Good stuff. And, you got to really think through, if you've been, let's run this scenario. You've been on the market for 30 days. You get an offer and it's $10,000 less than your list price. Okay. If your agent's doing their job, they're already talking to you at 30 days about dropping your price, maybe $5,000, right? Well, if you drop the price and you get another offer, it's probably still going to be lower than what your list price has moved down to.
Yeah.
Right. So that $10,000 drop on this offer 2 days before you drop the price, $10,000 or $5,000, whatever, looks like a pretty good scenario potentially.
It does.
It does. So anyway, all right, what's next?
Shiny penny. All right, this one's not real estate related at all. I don't think we can tie it, but that's your challenge. Tie this, what I'm about to say, back to real estate.
All right, let's do this. I'm ready. I got my coffee.
It is opening day of Major League Baseball season.
I got it.
Hip, hip, hooray. We've got the evil empire of the current day facing off against the evil empire of the 90s with the Dodgers playing the Yankees tonight. It's on Netflix, I believe.
It's just weird to me.
Yeah, it is. But yeah, so it's opening day of baseball season. And for those purist, sports fans who love just a true game that you can't cheat, man. I love this. Statistics in baseball don't lie. In a football game, you can get lucky and win a game that you shouldn't have won. In a hockey game, the playoffs are best of 7 series, but you can get on a hot streak. Your goalie can stand on his head for 7 games and sneak a series win that you shouldn't have had. But baseball, you can't fake it, man.
Mm-hmm.
Those statistics show up, and over the course of the season, it's amazing to watch happen. And I love the nuances of the game, watching how based on the pitch count, an outfielder might stand in a different position, like just the little things, man.
Okay, I'm tying it to real estate.
Tie it to real estate.
Are you ready?
I'm ready.
Okay, this is gonna be a stretch.
There was no off-camera prep for this. This is live.
Mental gymnastics. Here we go. Okay, I would consider myself Generation X. Okay,
sure.
The very end of it, but Generation X nonetheless. Gen Xers would like Rage Against the Machine, potentially.
Sure.
Okay.
Sure.
Home, the concept of home, is frequently built on nostalgia.
Okay.
Right? What you remember home being. Okay. You just said Evil Empire. Evil Empire was a great album by Rage Against the Machine. It brings back feelings of nostalgia. So those nostalgias get me primed to go home shopping. Mm-hmm. And if I walk into one and there's a Rage Against the Machine poster, I'm sold. And I'm wearing my Doc Martens today.
You're going to cross home plate as you're getting to the closing table.
There you go.
Yeah.
Mission accomplished, sir. Okay.
All right, that was a show.
It was a stretch for sure. And there's a 7th inning stretch. You're welcome.
All right, Trent, wrap us up, man.
Please get us out of here, Trent.
Thank you for listening to another episode of This Week in Real Estate with Jonathan Harmon and Bryan Nale, your go-to resource for all things real estate in Middle Tennessee. Be sure to like, share, follow, subscribe, and leave us a 5-star review. We will see y'all on the next one.
Now for the nitty-gritty. Premise Mortgage Company is a subsidiary of Premise Bank, a member FDIC. Premise Mortgage NMLS number 1894879, BK number 1042893, ML number 1894879. As always, all loans are subject to credit approval and product guidelines. Equal housing lender.